What if I told you that artificial intelligence is already managing parts of the global economy, and you didn't even know it? In 2025, while the world debated AI ethics and chatbot hallucinations, one corner of the financial world quietly changed forever. Private equity, an industry that moves trillions of dollars, shaping everything from what you eat to the apps you use, started teaching machines how to think like investors. Among all the players in this secretive world, one firm stood out: CVC Capital Partners. With over $200 billion under management and a presence across 30 countries, CVC didn't just adopt AI, they rewired their business around it. Private equity, or PE, isn't something most people think about. But behind nearly every household brand, from health companies to education startups, stands a private equity investor. These firms buy companies, grow them, then sell them at a profit. For decades, private equity relied on human instinct, dealmakers, analysts, spreadsheets. But the industry faced a problem: too much data, too little time. Every acquisition meant analyzing thousands of pages of reports, customer data, and financial statements. Enter artificial intelligence, and a company bold enough to reimagine investing itself. In 2020, CVC's leadership began asking a dangerous question: what if we could automate intelligence itself? Rather than treating AI as a shiny tech trend, they built it into the DNA of their investment model. They called it the Portfolio AI Operating Model, a scalable system that maps, builds, and deploys artificial intelligence across more than 140 companies worldwide. Think of it as a nervous system for an investment empire. CVC started by scanning all 120 of its companies, asking, where can AI make the biggest difference? They categorized each company into 3 groups: imminent disruption, likely transformation, and low impact. This helped them allocate talent and capital with precision, targeting the industries where AI could unlock value fastest. CVC's first breakthrough came from an unlikely place: education. The Multiversity group in Italy became a test bed for generative AI. AI handled student queries, automated administrative workflows, and even personalized learning content. Professor workload dropped by 80% and engagement soared. It wasn't just automation, it was augmentation. A real-world proof that generative AI could create measurable impact, not just hype. But the real genius of CVC's model lies in their MVP Accelerator, a program designed to turn AI ideas into working prototypes in as little as 6 to 8 weeks. Each project begins small: one use case, one company. And if it works, it scales across the entire portfolio. If it fails, it becomes a learned bet, a documented lesson for everyone else. Here's how it works step by step. Portfolio companies meet with CVC's AI task force to identify high-impact opportunities: repetitive tasks, large data volumes, measurable savings. Then, with access to internal data scientists, pre-built AI toolkits, and advisors, they go from concept to prototype in under 2 months. Finally, the results are measured using clear KPIs: time saved, accuracy improved, cost reduced. If successful, they go global. CVC isn't alone. Their rivals, Blackstone, Vista, Carlyle, and others, have all joined the AI race. Blackstone has invested heavily in AI infrastructure. Vista focuses on embedding AI into its SaaS companies. But CVC's approach? It's operational, embedding AI into the core of every business it owns. The impact has been massive. At Multiversity, administrative hours fell by 80%. In other portfolio firms, AI-driven analytics improved sales forecasts, reduced fraud, and optimized logistics. Across industries, CVC's portfolio companies became leaner, faster, smarter. Their internal rate of return and investment multiples are quietly rising, powered by data, not debt. But not everyone is ready. AI still needs people: creative thinkers, ethical leaders, curious analysts. CVC's success depends as much on its human intelligence as its artificial one. The future of finance isn't humans versus machines. It's humans working through machines. Even CVC faces serious challenges. Challenge 1. Talent shortages. 46% of firms say they can't find enough AI experts. Challenge 2. Data privacy. AI tools must comply with GDPR and global privacy laws or risk legal firestorms. Challenge 3. Bias and explainability. Black box algorithms can make unexplainable decisions, dangerous in finance. Challenge 4. Over-reliance. And worst of all, trusting AI too much could create blind spots that humans fail to see. For decades, private equity thrived on financial leverage, using debt to magnify returns. But today, the most powerful leverage is no longer financial. It's digital. CVC's AI-first approach shows that the next edge in finance won't come from capital. It'll come from computation. Soon, AI won't just assist financial decisions, it will make them. From deal sourcing to due diligence, from pricing to exit strategies, algorithms will decide faster than humans ever could. The markets of tomorrow may not be run by brokers, but by neural networks silently trading value in real time. The question isn't whether AI will transform finance. It's whether we're ready when it does.